Hey everyone, imagine a school of fish just vibing in the ocean, right? Suddenly this massive whale just swims by and boom! The entire current changes. That's kind of what it's like in the world of cryptocurrency with these things called crypto whales. These whales aren't your friendly neighborhood humpbacks though. They're individuals or groups holding massive amounts of a particular cryptocurrency. We're talking millions, sometimes billions of dollars worth. And just like that whale in the ocean, when they make a move, buy or sell, they can create huge waves in the market, causing prices to surge or plummet. So, if you're even remotely interested in cryptocurrency, you gotta understand these whales, their strategies, and how their movements can impact your investments. Stick around and let's dive deep into the world of crypto whales and how to navigate those choppy waters. Alright, let's be real for a second. You wouldn't jump into the deep end of a pool without knowing how to swim, right? Same goes for the cryptocurrency ocean. Before you even think about following a whale's trail, you gotta do your homework. And trust me, this isn't your boring old school homework. This is about understanding the game before placing your bets. First things first, fundamentals. Just like a house needs a strong foundation, a good cryptocurrency needs solid fundamentals. We're talking about its use case. What problem does it solve? What's the tech behind it? Is it blockchain, something else? Who's the team behind it? Are they legit, experienced, and transparent? And don't forget the community. Is there a buzz around it? A strong and active community can often be a good indicator of a project's potential. Think of it like building a Lego masterpiece. You wouldn't just start randomly sticking bricks together, right? You'd follow the instructions, understand each piece, and carefully put it all together. That's what due diligence is all about, carefully examining every aspect of a cryptocurrency before you invest your hard-earned money. Now I know what you're thinking, Mark, this sounds like a lot of work, and yeah, it can be. But trust me, it's way better to spend a little extra time up front than to lose your shirt chasing after the latest pump and dump scheme. Remember, slow and steady wins the race. One of the best things about the crypto world is the abundance of information available online. There are tons of resources out there, websites, forums, social media groups, where you can find detailed information about different cryptocurrencies. But a word of caution, not everything you read online is true. Be critical of your sources. Look for information from reputable websites, experienced analysts, and trusted community members. And don't be afraid to ask questions. The crypto community can be incredibly welcoming and helpful, especially if you're new to the game. Remember, knowledge is power, especially in the crypto world. The more you understand about a cryptocurrency, the better equipped you'll be to make informed investment decisions. And that, my friends, is what separates the guppies from the sharks. Alright, let's talk time travel, or at least the crypto version of it. One of the coolest things about cryptocurrency is that its entire price history is literally at your fingertips. We're talking charts and graphs galore. You can see every single dip, every pump, every single roller coaster moment since its inception. Now, I'm not saying the past perfectly predicts the future. That's like trying to predict the lottery numbers. Good luck with that. But looking at a coin's past performance can give you valuable clues about its potential. Think of it like checking out the track record of a racehorse. If a horse consistently finishes in the top 3, it's a good bet that it's got what it takes to win, right? Similarly, if a cryptocurrency has shown consistent growth over time, it might be a good indicator of future potential. But hey, it's not just about looking at the pretty green candles on a chart. You gotta dig deeper, my friends. Look for patterns, trends, and any significant events that might have influenced the price. Was there a major partnership announced? Did they release a groundbreaking update? Did Elon Musk tweet about it? Just kidding, sort of. Understanding these factors can help you understand why a cryptocurrency behaved a certain way in the past, which can give you some insight into its potential future performance. But remember, it's not an exact science. The crypto market is known for its volatility, and past performance is just one piece of the puzzle. Now, when you're analyzing a coin's past performance, don't just look at the short-term fluctuations. Zoom out, my friends. Look at the bigger picture. How has the coin performed over the past year? 3 years? Since its inception? This long-term perspective can help you filter out the noise and identify coins with real staying power. And remember, diversification is key. Don't put all your eggs in one basket, especially in the crypto market. Just like a balanced diet is important for a healthy body, a diversified crypto portfolio is essential for a healthy investment strategy. Okay, buckle up, Buttercup, because we're about to talk about the wild, wild west of crypto volatility and liquidity. Now, for those new to the rodeo, volatility is basically how much the price of a cryptocurrency swings up and down. Think of it like a bucking bronco. The wilder the ride, the higher the volatility. Now, some people see volatility as a scary monster. But you know me, I like to see the fun in everything. High volatility can actually be a day trader's best friend. Why? Because those big price swings mean more opportunities to buy low and sell high if you're quick enough, that is. But here's the thing, high volatility also means higher risk. It's like riding that roller coaster blindfolded. You never know which way it's going to twist and turn next. That's why it's crucial to have a solid risk management strategy in place before you even think about diving into the deep end of volatile coins. Now let's talk about liquidity, the other side of the crypto coin. Liquidity refers to how easily you can buy or sell a cryptocurrency without affecting its price. Think of it like this. Bitcoin is like a massive cruise ship. It's got tons of liquidity, so you can easily hop on or off without rocking the boat too much. But smaller, lesser-known coins? They're more like little dinghies. One person jumping in or out can send ripples throughout the entire market, making it harder to buy or sell at the price you want. That's why it's generally a good idea to stick with coins that have high liquidity, especially if you're new to the game. Now, how do you find these liquid gems? Well, one way is to look at the trading volume. Volume is basically the total amount of a cryptocurrency that's been traded over a certain period. High trading volume usually means high liquidity, which is what you want. But remember, high volatility and high liquidity often go hand in hand. They're like two peas in a pod, two sides of the same coin. So if you're planning on day trading, be prepared for a wild ride. And always, always have a plan. Alright, let's talk about everyone's favorite topic, risk and reward. It's like that classic game show where you have to choose between a guaranteed $100 or a 50-50 chance at $1,000. In the crypto world, every investment comes with its own risk-reward ratio. Now, some people, they're all about playing it safe. They're like those folks who always choose the $100. They'd rather have a sure thing than risk it all for a bigger payout. In the crypto world, these are the folks who stick to the big players. Bitcoin, Ethereum, Litecoin, the blue chip stocks of the cryptocurrency market. And hey, there's nothing wrong with that. These coins have stood the test of time, they've got solid fundamentals, and they're generally considered less risky than their smaller, more volatile counterparts. But then, you've got the risk takers, the gamblers, the ones who live for the thrill of the unknown. These are the folks who are drawn to the high-risk, high-reward coins, the ones with the potential to skyrocket in value overnight. We're talking about those smaller market cap coins, the ones with the crazy names and even crazier price swings. They're like those lottery tickets. You know the odds are stacked against you, but hey, someone's got to win, right? Now, I'm not saying you should go all in on some obscure meme coin you found on Reddit. Please don't do that. But allocating a small portion of your portfolio to these higher risk coins can be a way to potentially supercharge your returns. It's all about finding the right balance for your risk tolerance. Think of it like a seesaw. You want to find that sweet spot where you're comfortable with the potential upside and the potential downside. And remember, diversification is your best friend. Don't put all your eggs in one basket, especially when it comes to high-risk investments. Spread your bets, diversify your portfolio, and always, always do your research before hitting that buy button. Alright, let's talk about the finish line. The moment you've all been waiting for, cashing out those sweet, sweet crypto profits. You see, it's not enough to just buy low and sell high. You gotta know when to walk away from the table, even if you're on a winning streak. Having a solid exit strategy is crucial, my friends. It's like having a plan B, a safety net, a parachute for when things get a little too bumpy in the crypto skies. Because trust me, things can change in the blink of an eye in this market. Now, there are a few different approaches to crafting your exit strategy. Some people like to set a specific price target, say, a 2 times or 3 times return on their initial investment. Once their coin hits that target, they sell, no questions asked. It's like setting an alarm clock for your investments. Once it goes off, you know it's time to wake up and cash out. Others prefer to use a more technical approach, relying on charts, indicators, and other market signals to guide their decisions. It's like reading the tea leaves of the crypto market, looking for clues about when the trend might be about to reverse. But no matter which approach you choose, the key is to have a plan and stick to it. Don't let greed cloud your judgment. It's easy to get caught up in the hype, especially when the market is going crazy. But remember, what goes up must come down. And trust me, you don't want to be that person who held on for too long watching their profits evaporate like tears in the rain. It's like that old saying, bulls make money, bears make money, pigs get slaughtered, don't be a pig. So before you even buy a single Satoshi, take some time to think about your exit strategy. What are your goals? How much profit are you comfortable taking? What are your risk tolerance levels? Answering these questions will help you develop a plan that's right for you so you can cash out like a boss and enjoy the fruits of your crypto labors. So there you have it, folks. We've explored the fascinating world of crypto whales, those behemoths of the blockchain, and learned how understanding their movements can give us an edge in this exciting, albeit volatile market. Remember, knowledge is your most powerful tool in the crypto sea. But our journey doesn't end here. This is just the tip of the iceberg, the first step in your crypto adventure. The most important thing is to keep learning, keep exploring, and never stop asking questions. The crypto world is constantly evolving, and so should you. So go forth, my friends, armed with the knowledge and insights you've gained today. Dive deep into the world of cryptocurrency, explore different strategies, and most importantly, never be afraid to ride the waves of this exciting new frontier. Happy trading.